I'm going to be talking today about two concepts which are used frequently in the financial markets, but I feel not appreciated well enough. I also feel that these two concepts are the largest determinants of value creation and wealth creation in financial markets. These are concepts which are difficult to appreciate because they are not so obvious. How to think about these two concepts? The idea is to take these concepts right through into portfolio management decisions. So first, we'll go into what is history telling us. As George Santayana said, those who forget history are condemned to repeat it. So these are some sectors which have performed well, but on a structural basis, vis-a-vis the index, over a long period of time. So we are using a 10-year time framework. This is the private bank index compared to Nifty. What I want you to observe is that the top three players in this sector are taking 70 to 80% of the market cap on a consistent basis, which means not only were they a very large part of the market cap 10 years ago, but they've been an equally large part of the incremental market cap between then and now. So you will find that the first chart was reflecting the concept of picking the right mega trend, and the second chart is reflecting the concept of picking those companies which demonstrate leadership characteristics within that mega trend. Let me share with you some more examples. This is the FMCG index versus the Nifty. And this is the top three players in that space. And again, you will find a very large component, 60 to 70% of market cap and 60 to 70% of incremental market cap being generated by these three players. Taking a different sector, cement. Again, you will find that it is not oscillating around the index. And hence, it's a structural long-term trend, which is why we call it as a mega trend. And then, the share of the top three players in that segment, again, starting at 45%, going up to 70, close to 70%, which means that on an incremental basis, they would be adding more than 80% of the incremental market cap. Auto, and again, the leadership. So the mega trend here and the leadership here. You will find again that 60, 70, and now going up even higher. These are segments of market which do not have an index for themselves. So I'm only demonstrating the leadership component. 80 to 90% of the market cap consistently coming from the top three players in the NBFC space. And then in the consumer durable space, 60 to 70% of market cap. So the key takeaways here are that there are sectors which have consistently outperformed broader indices over the long term due to structural change. It is this structural change that we are classifying as megatrends. I was introduced to this concept of megatrend in the late 80s, there was a book called Megatrends by John Nesbitt and Patricia Nesbitt. They talked about megatrends at a very macro level, about the changes that are expected to take place at a global level. These megatrends are different and distinct from other sectors that have consistently reverted to mean while oscillating around the mean over the long term due to cyclical changes. So we are distinguishing between structural change and cyclical change. The cyclical changes could be global or domestic. And in most sectors, as we have established, top 3 market cap as a percentage of the sector market cap is high on a sustained basis, and in fact keeps rising inexorably over the long term. This demonstrates the importance of the concept of leadership. And lastly, as I said, because this leadership is sustained over a long period of time, these leaders take away a very large part of the incremental market cap. So let us decode the megatrends. As we discussed, megatrends are structural shifts that are longer term in nature and have irreversible consequences for the world around us. Why irreversible? Irreversible to the effect that they are not mean reverting, and hence structural. Megatrends have multiple dimensions, layers, and outsized implications that are very difficult to fathom at the very beginning. These trends last for 20, 30, 40, 50 years plus. Those are megatrends. We are not talking of 3 years and 5 year trends. And therefore, the outcomes are outsized. The mindset to pick megatrends require a very broad perspective and yet a very narrow focus. Why is that? Unless you see the big picture, you won't be able to get that megatrend. There are various approaches. Some books have called it change waves and talking about riding the change wave. But that broad perspective is very important. But why the narrow focus? Because there are very few such megatrends. When you do find them, you need intense focus to understand all the layers, all the dimensions, and keep tracking it over a very long period of time. And hence, the imperative for narrow focus. These megatrends reset the rules. They throw up new opportunities and threats. They throw up winners and losers. They transcend geographies, generations, and governments. So they are not because of the government, but despite the government. Hence, I feel that awareness of these megatrends offers a real insight in your decisions about your capital allocation. I'm sharing some megatrends that I perceive or I have perceived in the past, which are continuing even now. And I'm sure you may be able to think of a few others, or you may disagree with a few. But think of these trends. The IT revolution actually started in late 80s, early 90s for India. And Still continuing. Look at the difference that that sector has made to the whole country. Urbanization. I think it's a very, very long-term theme that is playing out. The demographic evolution for us. The consumption boom arising out of the demographic evolution as well as rising income levels, rising aspirations. Women in the workforce, very powerful theme. You will find a lot of these mega trends are interlinked. They reinforce each other. Women in the workforce will reinforce consumption as well. Financial deepening, very powerful theme. And we still have a very long way to go. Digital transformation, the unorganized to organized sector shift. And lastly, culling of dwarfs. I think this is a theme which is underappreciated. To the best of my knowledge, India has about 63 million business enterprises. And these statistics are there in the last economic survey. And they are defining dwarfs in that economic survey. These are companies which have not grown despite being in play for more than 10 years. The reasons could be many. They are either incompetent or uncompetitive or non-compliant or non-scalable or not profitable. They make up about 13% of the GDP and they employ about 30% of the total known employment in the country. These companies or these business entities are getting culled in the current environment. This process started quite some time ago and it keeps getting reinforced. This interface with the shift from unorganized to organized means that the leaders will keep getting more and more valuable. So I want to do a deep dive into one particular megatrend. So I'm picking one of the oldest megatrends that we have seen, the IT revolution. There were some very powerful factors which brought about this megatrend. I will classify them into three components. First, the benign supply conditions. So we had the capacity in the form of a large engineering skills base, large wage or salary differentials, and this was made possible by the precipitous drop in the cost of data transit and data storage. The flat world that we read about. If these conditions had not been there, then the IT revolution would not have happened. But they were necessary, yet not sufficient. To make that happen, we needed the second component, which is the changing demand side stance. And what was changing there? The change in the management thought process of focusing on core competence, which led to evaluating the possibility of outsourcing those functions which are not part of the core competence. And finally, the catalyst. The catalyst was GE's pioneering outsourcing to India. Because of these demand side conditions and supply side conditions, this megatrend became possible. But for this megatrend to sustain, we needed the third component, which is the innovative business model. The concept of offshoring, the global delivery model, offshore dedicated centers, master service agreements, infrastructure management service. These evolution of business model was necessary to sustain the megatrend. If we did not have all of these three components, this story would have been very different. Let me show you the data. This was the fall in the data storage and data transit costs. This was the salary differential, but I've only used data since FY03. In the 90s, the salary differentials were even more stark. Once the megatrend is in place, you need scalability and granularity. Without scalability and granularity, the megatrend is just a potential. This scalability and granularity is reflected in multiple ways. So, here is the compounding of the scalability over a long period of time. If I pull this back to the 90s, you will find that the charts are in fact parabolic. And here are the number of customers who are giving more than $100 million of business to these companies. And again, you will find the same trend. In fact, these two charts reinforce the scalability demonstrated by this sector. Let me talk about granularity. Granularity is more easily understood in the retail context, less easily understood in the B2B context, and which is why I think this is very useful. On the bottom left, we have the number of verticals that were being serviced by the Indian IT players. These verticals comprised 80 to 90% of the sales at that point of time. And how, over a period of time, you will find that they kept on adding different verticals. This addition to verticals kept on expanding the total addressable market for these companies. They kept on expanding their core competence skill sets across more and more verticals, contributing to the scalability. And then on the bottom right, we have the products and services which were being offered by these companies and how they kept on adding different services or solutions on a consistent basis. They define it as lines of businesses. So between these two components, the business kept on becoming more and more scalable and yet granular. And this scalability and granularity, we think of only in terms of them being growth enablers and drivers to that growth. But we should think of them as more than just growth enablers and drivers. They are also de-risking these businesses, de-risking these companies, and giving them scalability. I want to talk about this concept of displacement. And I'll elaborate a little more on that later. But for any megatrend to reach its potential, a lot of displacement is needed. So, in the very early 90s, IT outsourcing spend as a percentage of the global IT spend was almost zero. You will find that today it is consistently 30% of the global IT spends. The journey from almost 0% of the global IT spend to 30% of the IT spend is the displacement that has created this opportunity. Within the outsourcing piece, offshoring was the profit driver. And you will find how offshoring has kept on increasing, such that it has reached a level of more than 70% of the total revenues. While the initial business started as body shopping, it's a very different business today. Both these components drove the growth, but why did they drive that growth? Why was there a need on the part of those customers to keep doing offshoring, to keep doing outsourcing? And the reason is here. IT budgets as a percentage of revenue, on the bottom left chart, you will find range from 1.5% to 5%, which some may argue is not a very large component. But when you compare it to the operating profits of those sectors, you will find that IT spends as a percentage of the operating profits is much higher. This is just operating profits as a percentage of sales. So you compare, for example, in the consumer and retail space, IT spends are 2% of revenue and operating profits are 4% of revenue. So they are 50% of operating profits. You need that efficiency on your IT spends which is 50% of your operating profits. In the financial sector, IT spends have been, on an average, 50 bips or 0.5% of the AUM. Think of it in a world where the return on assets are 1.5%. This is 50 bips, 1/3 of that. The same sector, for the megatrend to sustain and persist over a very long period of time, also needs to demonstrate resilience. This megatrend persisted through the dot-com crash, through the global financial crisis, and demonstrated adaptability. So you had mini computing, followed by the client server, followed by internet, followed by ERP, and today we have social media, analytics and cloud, or SMAC, or digital. You will find that these companies kept on innovating, and that helped in sustaining the megatrend and elongating the megatrend. And lastly, transformation. Intrinsically, the IT services business is a projects business. You get one large project from one large customer. It should have resulted in lumpy revenues, lumpy profits. It should have resulted in disproportionate volatility. And yet, these companies have managed not to do that. What did they do right? Granularity. In terms of verticals, in terms of customers, in terms of lines of business, in terms of wallet share of those customers, combined with long-term contract rollovers, the master services agreements that we talked about, which resulted in a business model which delivered annuity streams at scale. So while each contract was lumpy, because you had so many contracts which you were delivering simultaneously, the whole was very different than the sum of the parts. And in the process, you became globally competitive and demonstrated leadership at a global level. Best in class. If you look at the bottom right chart, this is the incremental revenue of the top 4 Indian companies as compared to the incremental revenues of the top 2 global companies, which is Accenture and Capgemini. And you will find that the Indian companies, having a much smaller base, were on an incremental basis delivering the same absolute numbers as the large 2. That brings us to what I call as resilient value creation. We are all aware of this concept of competitive advantage period. It is difficult for any company of any sector to keep delivering return on capital employed, which is greater than the risk-free return over a very long period of time, and to keep delivering growth, which is faster than the GDP over a very long period of time. This sector and these companies have delivered both those. So you will find that they've delivered return on capital employed, which is much higher than the threshold, and growth, which is much higher than the global GDP growth over a very long period of time. So consistently high return on capital employed, consistently superior growth rate are very important components of the wealth creation in these megatrends. The competitive intensity should have come in by this time, or in fact even much earlier, yet it did not. The return on capital employed and the superior growth rate sustained. And why was that? It is because this competitive intensity was mitigated by the size of the opportunity, the quality of leadership, scalability, moats, and innovation. And while everybody talks about strategy, execution is the real crux. Very few potential leaders are able to execute. These leaders demonstrate profitability, scalability, and durability. Durability is important because that reflects the longevity of your competitive advantage, the longevity of your ability to generate superior growth and superior returns. These leadership companies are battle tested through multiple cycles. They demonstrate resilience and adaptability. Maybe we should add agility as well in this day and age. But adaptability is very, very critical. Lastly, prudent capital allocation and capital structure. Mistakes on capital allocation and capital structure compromise not just your return on capital employed and growth, but actually your durability. And how companies can transition to institutionalization. We keep talking about management quality, but in many ways that management quality is very much centered around individuals. When you think of management depth and transition and to an institution, that makes the difference. So these are some of the popular icons of companies demonstrating these leadership attributes that we've all talked about. Just like we drill down into the Megatrends case study, I want to share some examples of some attributes, and I'm distinguishing between quantitative attributes and qualitative attributes. Maybe some of the names that I have put, you may have a different point of view vis-a-vis that particular factor, but the idea is not to focus on what factor and which company. The idea is to think of the possibilities that one can, the dots that one can connect. So we'll go over quantitative attributes first. The conventional way of looking at leadership attributes are first market share. One of the names that comes to mind is Asian Paints, 53% market share of the paint sector. Then the delta market share, which is market share of the incremental sales. Bajaj Finance has been an absolute blockbuster here. Least cost player, Shree Cement. I've tried hard to pick examples from different sectors. The share of profit pool of that sector. It could be a sub-segment of a sector as well. The share of cash flows of that sector. Maruti here. Leadership durability. For how long can you sustain market shares in each of your product segments, in each of your categories? I think Nestle is one of the best examples that I could think of there. Leadership in new segments. How you look at adjacencies and take leadership in those adjacencies. You need not always be the first mover, but you ensure that in each of the adjacencies, each of the segments, each of the sub-segments, you take up leadership positions. You are in the top 3 in each segment. HDFC Bank there. Let me give you some examples of qualitative attributes. Culture, I could be biased, but Titan has demonstrated phenomenal culture over a very long period of time, including institutionalization and management transition now. Innovation. When we talk about innovation, most people think of technology. So I deliberately took an example which is not technology. You'll be surprised to think of all the innovations that Nestle has done at product level, at packaging level, at distribution level, and so on. Execution. TCS has done a splendid execution over a very long period of time. Expanding the total addressable market. Bajaj Finance again, how they have evolved their business model beautifully. Elongating the competitive advantage period. the things that DMart keeps doing. Embracing disruption, Info Edge here. And how you're redefining your competition, HUL. As I said, I'm sure you can think of other examples, and I'm sure you can think of other attributes. But it helps to keep thinking of putting together this list of attributes and companies which are demonstrating those attributes. I strongly believe that economic cycles amplify leadership. And I want you to think about that sentence for a little while. Amplifying leadership through economic cycles means that with every cycle, your leadership is not just reaffirmed, but redefined as well. And I think your leadership becomes even stronger than ever before. You get the opportunity to extend and expand your leadership through each cycle. Each cycle, we know, leads to creative destruction, what Schumpeter called creative destruction. Each cycle results in what I call as non-linear shifts. These non-linear shifts take place in businesses, business variables, and business models. Economic cycles are usually caused by this 4D framework: debt, disruption, displacement, and disintermediation. I think we are in the midst of one of the most acute economic cycles that I remember. The very interesting thing about economic cycles now, not just in India but globally, is that each cycle is contracting. There's some very interesting work done on economic cycles, originally by Kondratiev and then by other economists. Kondratiev talked of the 78-year or 74-year wave, and now economic cycles keep becoming shorter and shorter and shorter. So when the economic cycle duration is shrinking, sustaining your competitive advantage period is that much more tougher. And this has very large implications on your decision making when you are investing. It also challenges the valuation multiples that we are assigning to the companies that we invest in. That was the macro perspective of the cycle. I want to take you through the micro perspective of the cycle as well. In each cycle, there are new incumbents, new challenges. And the power between the incumbents and challengers shifts. And you have to be able to perceive that shift of terms of trade, the shift of power. In each cycle, men are separated from the boys. So you have to be clear, whom are you backing? Are you backing the men or are you backing the boys? The treadmill speed and incline keeps rising. What do I mean by that? The bar is raised in every cycle. What was good enough in the last cycle is not good enough in the next cycle. It is just table stakes in the next cycle. Which is why it is imperative for management teams to keep reinventing and redefining themselves. It's a very difficult thing to do, and very few companies are able to do it. The value paradigm also evolves in each such economic cycle. It is always fine-tuned. And I can give you many examples of that, but maybe we can cover that in the Q&A. The value migration accelerates with each cycle. And each cycle gives you the opportunity to expand the total addressable market by giving you inflection points. But only the adapters can take advantage of that. So how do we value megatrends and leadership? I don't have a formula for that. So I'm sharing some of my thoughts with you. The first is, it is imperative to value intangibles. It's not just a numerical exercise. The second is, this value is reinforced and magnified through economic cycles. So the classical value investing approach, which assumes mean reversion, will be challenged when applied to this situation. Intersection of megatrends and leadership is a multi-sigma event, really rare. And hence, valuation metrics cannot reflect this outlier event appropriately. I remember that many years ago I read about hindsight PE, how companies which appeared to have very high PEs in US in the 80s, if you had perfect 20/20 hindsight 20 years later, then those PEs actually were very low if you took the price of the 1980s and the earnings of 2000. Okay? Because over a very long period of time, those companies grew their earnings much faster than the others. And in my view, those earnings grew much faster because of megatrends and leadership. And hence, those companies which appeared to be very expensive in the 80s were actually very cheap in hindsight. The terminal value impact of megatrends and leadership is disproportionate. In investing, we all aspire to arrive at that or to encash that terminal value eventually. But it's a distant dynamic truth, right, that we are pursuing. Hence, small changes in megatrends and leadership result in outsized changes to terminal value. This cannot be captured in the conventional valuation frameworks. So applying those does not help. I explained to you that favorable value migration takes place through each cycle. And again, it's difficult to capture that favorable value migration in your conventional valuation frameworks, since these megatrends and leadership attributes persist over 20, 30, 40, 50 years. As Bill Gates said, we overestimate change in the long run and underestimate change, we overestimate change in the short run and underestimate change in the long run. That is true for megatrends and leadership as well. And valuations have to reflect that reality. So how do you incorporate this concept of megatrends and leadership into your portfolio management? This is the way I do it, so I'm sharing it with you. I'm sure you would have different takes on it. So I focus on 3 to 4 megatrends where I have high conviction. It is important to prioritize the megatrends that you're pursuing. In each megatrends, I identify 2 or 3 players who are demonstrating leadership attributes. They may or may not be leaders at that point of time, but they should demonstrate leadership attributes. From this short list, I classify those into clear leaders, near leaders, and emerging leaders. So of my portfolio, the ballast component is made up of the clear leaders, the battle-tested management teams who are participating in the large megatrends, where the megatrend is already well established, where the management teams have demonstrated resilience and adaptability. Those are clear leaders. Then there is an aspirational component of the portfolio, which comprises near leaders. These are companies participating in the same megatrends, which are not yet obviously leaders, but are demonstrating quite a few leadership attributes. Not many enough to be clear leaders, but are demonstrating those attributes. They comprise the second bucket of the portfolio, the aspirational bucket of the portfolio. And the third component of the portfolio is the high risk component, which is the component of emerging leaders. Emerging leaders are typically demonstrating only one or two leadership attributes. They are not yet battle tested. They have not yet gone through multiple cycles. And therefore, the probability of those emerging leaders being clear leaders 10, 15, 20 years down the line is very low. And hence I call them as high risk. This is not about defining companies in large cap, mid cap, and small cap. This is defining companies in terms of their leadership attributes. And lastly, after doing this whole exercise, I need to have high concentration in my portfolio to reflect my conviction in the megatrends that I am pursuing and the leadership attributes that I am pursuing. Because each megatrend and leadership has such outsized impact on the portfolio, you cannot have too many of them. And you will not be able, even if you wanted more, it is difficult to find too many companies where the intersection of megatrends and leadership is available. Mind you, I'm not even bringing the valuation filter in. Even without that, I struggle to make up 12 to 15 companies in the portfolio. So many years ago, I read about guerrilla investing. And of course, that book talked about guerrilla investing in a very different context. I'm changing the context and applying that to these megatrends and leadership attributes that we have discussed. This is just to show the difference in size. This is the gorilla, this is a dog or a monkey, and this is a man. There are many monkeys in the jungle, but very few gorillas. So I'm trying to demonstrate that you will find very few. This is consistent with what Warren Buffett says about having only 20 punching cards. These gorillas are outsized as compared to monkeys. They are dominant. I loved one slide in Titan's presentation which said, you're going from leadership to becoming a legend. Dominance is a very important attribute to these companies which are participating in large mega trends and have leadership attributes. The dominance keeps increasing. It is not just being a leader. It graduates and evolves to being dominant. The gorillas are not challenged by monkeys because of moats and knights, as we have learned. Gorillas have a lifespan double that of monkeys. The longevity and the durability of both the megatrend and the leadership attributes lead to much more effective compounding. So one has to find the right jungle in which the gorillas are there, which is find the right megatrend and find the right animal, which is the animal which has the leadership attributes to be able to invest in gorillas. Now, none of us is perfect and we are going to make mistakes. So you will end up with a portfolio which has a few gorillas, and the others which you were hoping would be gorillas don't turn out to be gorillas but end up being monkeys. Over a period of time, the few gorillas will keep performing very well and keep becoming a larger portion of your portfolio, and you will consciously, once you recognize that this gorilla is not a gorilla but a monkey, you will consciously exit the monkeys and keep adding what you think are gorillas. And as that proportion of gorillas in your portfolio keeps rising, your portfolio keeps improving over a period of time. So this plays out over a very long period of time. No matter how good you are, on day one your portfolio cannot be full of only gorillas. That's all that I had to say on this concept. And I know that this is quite, there are a lot of soft factors involved here, but I would be very happy if these thoughts that I leave with you take greater, larger and stronger shape in your minds, and you find them useful in your investment approach. Thank you very much.